Good morning and welcome to today's webinar, Investment-Only Platforms, a Bespoke and Flexible Solution, Part 1. My name is Rachel Pine and I look after content for the PLSA's events and training. We're delighted to be back with our webinar series after taking August off to let all of you enjoy your summer holiday. We're so pleased to welcome Phoenix Corporate Investment Services as our newest education partner. They're here today to tell you all about how investment-only platforms can provide schemes with long-term investment options that also help to keep costs down while offering a wide variety of investment types. Today is the first of a two-part series, and you're going to learn about how investment-only platforms work, the opportunities they provide for trustees and advisors, how reporting and fact sheets work in this area, as well as some additional information. Part 2 is on September 24th, and we'll show you how to register for that as well. Speaking today on behalf of Phoenix are Jess Williams, their Senior Manager of Corporate Investment Services and Relationships, and Nick Trinder, who is also a Relationship Manager there. Before I turn this over to Jess and Nick, I wanted to tell you a little bit about Phoenix. They are an investment-only platform with over £8 billion of assets under management, which they hold on behalf of large UK institutions. Phoenix have a 20-year heritage of partnering with pensions to meet their strategic and investment requirements for trustees as well as for scheme members. In today's webinar, we'll be asking you some polling questions which will pop up on your screen. You can also ask questions in the Q&A box, and you can vote up questions that other people ask that you'd like to have answered as well. And of course, you can chat with the speakers and the rest of the attendees in the chat box. Before we get started, we had a quick poll for you. We wanted to see if you've ever considered the benefits of an investment-only platform. So if you just want to vote, it's great when lots of people vote. It gives us an idea of how familiar people are with this topic. Have you considered the benefits of an investment-only platform? Yes, no, or you're not sure. Probably should be, has your scheme considered the benefits? I'll give you all another couple of seconds to vote there. Looks like very good. So I'm going to show you. So it looks like more than half of you have considered the benefits of investment only, and that's a really good place to start off. So I'm going to introduce Jess Williams. Good morning, Jess.
Hi, Rachel. Thank you for that. And that's interesting, actually, that results of that poll. So that gives us some, some hope for the future, and hopefully we can solidify some of those responses and develop on that today to give everybody a little bit more meat to the bone of an investment-only platform and what it can do for you. So good morning, everyone, and thanks for joining us today. Nick and I are really pleased to be here to talk to you about how utilising an investment-only platform can offer trustees of investment of occupational schemes options and help you with some of the challenges that trustees currently face. And to this point, I would say this is around the requirement for oversight and increased governance that trustees are now facing, demonstrating value for money, understanding what everything is in that cost chain, providing sufficient and appropriate choices for members to access the right managers for the options that members need. And I think in particular at the moment, obviously what's current is that requirement to incorporate ESG solutions, both into default and standalone funds to meet the ESG appetites of your members. And how are you going to make those changes to meet that demand? Also at the moment, another area that clearly is key is around the reviewing and deciding what you want to make available to your members for at and post-retirement options. And these are some of the key decisions that trustees are taking that an investment-only platform can help you with when you're looking at these decisions going forward. Also, one of the things that investment-only platform provide is clear reporting to help trustees where they report to their members on performance so they understand that where their investments are, but also around charges, including transaction charges, and we'll talk a bit more about that later today. So firstly, I just wanted to talk about how in financial services, we talk a lot about investment platforms and platforms in general. So I just want to be clear about what we're talking about today. What do we mean when we talk about an investment-only platform and how it works and what it is and what the roles and responsibilities are in delivering for an investment-only platform? And perhaps more importantly, what it isn't. So investment-only platforms are, when we're talking about it today, specialise in developing fund solutions for institutional clients. This is not a retail wrap platform. And these clients can include both DC and DB schemes, but also master trust clients too. So I think we've now got a slide, which I think is about to come up, where in the relationship with a scheme that an investment-only platform works. So I think yes, here we are. So the role of an investment-only platform and where it sits in that relationship. So as you can see, right at the heart of that delivery are the trustees and the pension scheme itself. But these institutional clients are advised by our investment consultant community, and it is those advisors and the clients who will decide on the managers, the funds, and how those funds will be constructed for the good of members. An investment-only platform do not advise on the funds to use. They do not pick the funds, nor do they look to make the changes. They help you by just making those funds available, and when you want to make the changes, helping that happen. Investment-only platforms are the builders. They follow the trustees and the consultants who are the architects of change. The investment-only platform makes the investment requirements become a reality through developing tailor-made solutions for clients and offering that access to a wide range of underlying investments. Also on the slide here, you can see the other important relationship here is the administrator, the scheme administrator. Now, whether that is utilising in-house expertise or one of the great external the third-party administrators we see, again, this is all chosen by the trustees. We don't do that. We will work with them, and we don't hold the member records as an investment-only platform, but we do have automated links with the trustee scheme administrator, and it's important for the trustees and their advisors that these links are provided in a controlled risk environment. So if we take the slide down now, how can an investment-only platform help you meet some of these current challenges? Well, first of all, it's around the breadth of funds and the managers that we can access. It is the ability to access preferred best-in-class solutions for specific asset classes. And this is no more true than at the moment when we're looking at ESG solutions and those kind of different managers that clients may want to utilize. It's the ability to access multiple fund solutions without needing a relationship with each individual fund group. We do that for you. We do the heavy lifting for you with the fund managers to make those funds available. You work with the platform and we work on your behalf with the managers that you want. I made the point earlier about costs and value for money. We are looking at ways to help you reduce cost and give you the best possible rate for members. Now, this can be done through the platform scale and purchasing power because we utilize that across all of our client assets. However, if a scheme or a consultant has negotiated a rate with a particular manager, we can ring fence that, and a good investment-only platform can ring fence that for your requirements. Therefore, an investment-only platform can offer you true transparency of that investment journey and what the cost is of each element in that journey to help you make the decisions about what offers you value for money in your investments. What you'd also expect is that robust trading process with the scheme administrator through straight-through processing wherever possible that requires little to no manual intervention. And one of the things I'd say, for example, we have, I think it's about 99.5% connectivity with our STP administrators, and we are working on that last 0.5%. Also, it's around regular and consistent investment performance data. It's giving it you from one source so you can pull that all together and so you can truly get an idea of how your underlying investments are performing for you. We can offer you fact sheets, how you want to see them, with the objectives that you want, with the benchmarks you need, with your branding and logos if required. And also an investment-only platform will help you in terms of providing input with either your own microsites for your members or with the administrator's microsite to help that member digital experience by providing the data that's needed for members to see. We can support you with governance requirements. And I think one of the things we're seeing key at the moment is around that transaction costs, or where you're making change about the implementation of a transition and what do those costs look like. And we can pull all that together for you. An example is we do have one client who has 28 underlying managers. And so the pulling together of that transaction cost data would be a huge headache for them without the use of an investment only platform, because we've been able to do that on their behalf, and we can coordinate that to pull that together to give them meaningful data for their chair statement. But I suppose the number one way that an investment only platform can support you is around that building of bespoke investment solutions to meet the specific needs of trustees and their members. And in those fund solutions, it's the ability to access different investment vehicles. I think that's something that our investment only platforms have historically been perceived not been able to do, not been able to access different types of investments. So I'm now going to hand over to my colleague Nick, who's going to talk you through some of those options that are available, but also how an investment only platform can help build those solutions and drive real value for money efficiencies. So thank you. Over to Nick. Nick?
Unmute yourself, Nick.
Thank you, Jess, and good morning, everyone. Thank you for joining us this morning. Jess has provided us with an overview of the features that trustees will be looking for from an investment-only platform, but what investment solutions are available to the trustees of both DC and DB schemes. It's fair to say that no two schemes are alike, and therefore investment choices will be unique to each individual scheme and the requirements of their members. However, there is one overarching feature that platforms offer trustees, which is the ability to access different investment solutions, both funds, other investment vehicles that we'll take a look at in a moment, and from a multitude of fund manager groups and providers. But perhaps now is a good time to ask another question of our audience. I think Rachel has another poll, and be very interested to seek the views of our audience here.
I do have a poll, in fact, Nick. For your main scheme, how many managers stroke providers do you access for the scheme's investment options? 1, 2 to 4, 5 to 7, or 8 or more? Once again, everyone could vote. It really helps everybody understand what who we're talking to, what kind of work you're doing. So thanks for that. For your main scheme, how many managers and providers do you access for the scheme's investment options? So once again, the choices are 1, 2 to 4, 5 to 7, 8 or more. Give you all another few seconds to vote. Looks like the vast majority have voted. All right, I'm going to share the results. So it looks like fairly complicated. Most people, or nearly half, are in the 8 or more category. So that's something to think about, Nick.
Absolutely, that's really interesting. We've seen sort of, I think, different behaviours and different actions taken by certainly DC scheme trustees over the past few years. Some have recognised that they may have too many options and begun to consolidate them down to a certain number, but I think the trend that we've seen for a long period of time now is a recognition that perhaps one manager can't offer everything, and they can't offer a solution that potentially that is the best, say, diversified growth fund, the best global equity fund, the best emerging market equity fund, the best corporate bond fund, etc. Perhaps if we move on to the next slide, and we can begin to look at some of the fund solutions that a platform can actually offer scheme trustees. I touched there upon access to multiple fund managers and providers. This is very much about gaining a best-in-class solution for each asset class, and a recognition that spreading one's investments across multiple fund managers and access to those fund managers can provide trustees with access to the funds and solutions that they wish to provide for their members. Another commonly used solution from trustees is blended funds, and we'll take a little look at that in a moment as to how the trustees can coordinate and create blended funds using a combination of some of the funds and investment vehicles available to them. Other solutions that we commonly see on platforms include target dated funds. This has been part of the UK investment universe now for a good 10 years. And not just standard off-the-shelf target-dated funds from investment managers, but we work very closely with investment managers to bespoke these, perhaps with custom vintages, or perhaps with an ESG tilt applied to them as well. And on the subject of ESG, the emergence of environmental, social and governance strategies, ESG strategies, has been prevalent throughout all our conversations with clients and consultants over the past 2 or 3 years. 5 or 6 years ago, this really wasn't that hot a topic, but what we've seen is an emergence of different solutions. These include ESG tilted passive funds from some of the major beta managers in the UK, but also some more niche strategies. And we've established conversations and fund links with perhaps less well-known managers who are able to provide specific solutions to meet the very close requirements of the trustees and their members. That brings us nicely onto exchange-traded funds as well. Again, perhaps a niche solution, something that we're not necessarily expecting to see billions of pounds worth of assets invested in, but exchange-traded funds are available on platforms and can provide trustees and their members access to certain asset classes, looking at things like commodities, gold, perhaps specific indices as well. And with an exchange-traded fund, they can be included within a blended fund as well. That brings us nicely onto non-daily dealt funds and illiquids. Examples in this area include assets such as private equity and infrastructure. Not necessarily funds where money will be flowing in, day out, very much a long-term play. But I think increasingly DC scheme trustees want to include this within their solutions. And again, the non-daily dealt funds can form part of a blended fund. And as applicable as they are now in the DC space, these types of strategies have been used for DB schemes for quite a considerable period of time. And platforms have developed solutions that go a bit further to helping DB schemes meet their needs. These include liability-driven investments, LDI, and also cash flow-driven investment solutions. And as books of smaller, medium-sized DB schemes look to utilise platforms, these solutions are an absolute must to obviously meet the de-risking needs of trustees of DB schemes. And that often sits alongside things like buy and maintain strategies and also segregated mandates.
Right, Nick, I wanted to interrupt you here for a second, if I may. What's the criteria for adding funds onto your platform? How do you choose them?
Yeah, it's a great question, Rachel. I think it's probably more a case of funds being driven and the fund selection being driven by client consultant demand. For our own platform, we don't select funds. We don't have any in-house sort of tie-ups with any in-house funds managers. It's very much about looking at what our clients and consultants demand and establishing fund links with particular managers to gain those funds on the platform. So sometimes we've got an arrangement with an existing manager, and very simply we can add new funds to the platform within 4 weeks from those managers where we have an existing agreement. And as has been sort of quite common, especially with ESG investment strategies and some of the niche arrangements, we've entered into new agreements with funds managers. But where there's a need from trustees, there's obviously a good level of investment ready to go into the fund, and the fund meets permitted links rules for DC schemes. That essentially is a criteria, but it's driven primarily, Rachel, by client and consultant demand.
Very good. Thank you for that. I want to remind everyone that you can keep putting questions in the Q&A. I get to blurt mine out, but if you ask questions, we will get to them at the end of toward the end of the presentation. Thanks, Nick.
Okay. One thing I've not necessarily expanded on that's included in this particular slide is blended funds. And perhaps if we can just take a look at an example on the next slide as to how blended funds operate. And what we've got here is a particular example for a client. In this instance, we've created a blended fund. It's titled at the top of that chart there, the Moderate Growth Fund, and it comprises of 3 underlying funds, an emerging markets fund from fund manager A, just a small allocation there, roughly 5%. 67% of the fund is invested in a global developed equity fund from fund manager B, and the diversified fund is comprising 28% of the fund provided by fund manager C. And in essence, this example is a classic case of where trustees have looked at different funds managers, a universe of funds managers that are out there, and selected the best in class for each of these three asset classes, even though it's from three different underlying funds managers. What the platform then does is blend those three funds together into one solution, which is the moderate growth fund. And essentially, as a scheme member, all the scheme member will see is I'm in the moderate growth fund and I hold a certain number of units in the fund. And the great advantage of doing this is that even if an underlying fund is changed, so let's say the trustees and their consultants look at the diversified growth fund, they're not happy with funds manager C, they want to bring a new fund in from funds manager D, for example, that fund can be changed seamlessly with minimal impact for the trustees, the members, and the scheme administrator. And I'll talk through briefly how this works. So the fund's performance history is maintained for the moderate growth fund. So trustees and members get continuous fund performance history and can look back and compare over previous time periods. There is no change in the number of units held. So a member who held moderate growth fund units still holds the same number of units, even though an underlying fund has changed. Typically, no blackout period is required. So members can continue to trade. Even the day a change is made, contributions may still be flowing in and out of this particular solution. And if the trustees so wish, there is no requirement to communicate to members. And I think probably the most important of those four that we've run through is the fact there is no change in the number of units held. We know that reconciliation of units, a big switch, that's a bulk switch that's taken place by scheme administrators, it is a complicated exercise. There is a big reconciliation exercise that needs to take place. Blended funds can help trustees make changes to their funds without that impact on scheme administrators. We'll actually, Rachel, take a little look at this in a bit more detail during our second webinar that is due to take place on the 24th of September. Okay, we can probably remove that slide now, and I'm going to move on to some of the day-to-day operation of an investment-only platform. And how does this work for perhaps some of the more routine transactions that we might look to see? I'll start with member switches, and where a switch will come through from a scheme member looking to sell units in one fund and purchase units in another. The investment platform won't wait for the sale leg of that switch to complete before them making a purchase in units 3 or 4 days later. That would create out of market exposure for the member. So the way platforms work is they will look at what's being sold, they will look at what's being bought, and simultaneously place a buy and sell trade to help minimize out of market exposure for scheme members. The other feature of a platform is that we have hundreds of clients across the platform, all doing different things on the same day. So one client might be selling units and another client might be buying units in exactly the same fund. What we don't do is place 2 trades with the underlying funds manager for each client. We will take a look at the overall net position. So if one client is buying £1 million worth of units and another client is selling £750,000 worth of units, we will only place a trade to buy 250,000 units with the underlying funds manager. Now you might ask, what's the significance of this? Essentially what we're doing by creating smaller netted off trades is helping to reduce transaction costs due to the level of trades placed with underlying funds managers. And sometimes that netting off can actually get the position down to a very small trade that is required. And another feature of investment-only platforms is that we tend to hold what's known in the trade as a box position. So this will be a few £1,000s worth of units in each fund. And the reason we do this, I'm sure looking at DC schemes with self-select members, there will always be one or two self-select members who have a relatively small trade in a given fund each month, £25 here, £50 there, and it's really quite inefficient to be placing those sorts of trades directly with underlying funds managers. So the platform, as well as aggregating these, if we are left with a very small position, we have a box position, we hold the units, we hold those units and allocate them to the members and the scheme's account, rather than placing trades with underlying fund managers. And again, that just helps to reduce transaction costs. But probably my personal favourite of all the efficiencies from an investment-only platform is those efficiencies that can be created through the blended fund structure. And if we move on to the next slide, this helps demonstrate how a blended fund can help with smarter allocation of contributions and also help reduce transaction costs. So we're coming back again to our example of our moderate growth fund. You'll see there exactly the same underlying funds and percentages. Except we've got a slight difference in that there are some numbers along the bottom now. And you'll see for the Global Developed Equity Fund that fund is now underallocated. It should have 67% of the moderate growth fund should be in that fund, but due to market movements, it could be down to falls in equity markets. We now only have 64% of our monies invested in that particular fund. So what can we do through the blended fund structure to help that? Typically, again, for our DC schemes and for some DB schemes as well, there are regular contributions coming in to the scheme. That could be the monthly payroll, the monthly deduction of contributions for your employees. Now, when those contributions are received by the platform, rather than allocate those proportionately across all three funds, i.e. 5%, 67% and 28%, platforms will look at any funds that are underallocated, in this case, Global Developed Equity Fund, and allocate 100% of the premiums and contributions to that underallocated fund. And through this cash flow rebalancing mechanism, we can quickly get that fund back to target. Obviously, sometimes we're fighting against markets, and we'll come back to that in a moment. But the purpose of doing that is by using cash flow, we're only making the one transaction in the underlying fund rather than allocating across all three equally and then having to rebalance the fund at the end of the month, at the end of the quarter, and incurring more transaction costs in doing that. We've had, I think, some real challenges over the last 6 months with COVID, and this is where this structure has come into its own a little bit over the last 6 months. COVID has caused great volatility in the markets. Swings of 5, 6, 7% have not been unknown during the worst of the turbulence back in the end of Q1. And for one particular client, we operate roughly 6 blended funds of theirs, and we were monitoring this very closely. And actually, through the use of cash flow rebalancing, through monitoring those funds very, very closely, the cash flows were actually sufficient to put the clients in a position where I think the blended funds that they had only rebalanced once during Q1 and Q2 during the COVID crisis. So smart rebalancing can really help cut down those transaction costs. They can help keep the funds on track to meet their investment objectives. And essentially, that can be combined with other checks. So if you want to put a tolerance check onto some of those funds and make sure it doesn't go more than plus or minus 4% from its target allocation, that can be done as well. So I think finally, when using an investment-only platform, we also need to ask ourselves whether the administrative processes are sufficiently automated and robust, and are the controls effective? And in the case of blended funds, they are fully automated, systems controlled, and tick the boxes in that respect. I think we can probably move on from this slide and take this down for a second. And we'll take a look at, on a daily basis, what happens with member instructions. How does the tech, how does the automation actually work with an investment-only platform? So on a daily basis, we know all our scheme administrators that we work with, our third-party administrators out there, are receiving instructions from their members. And we have links with the leading links with the leading administrators through straight-through processing using industry standard Swift messaging. This ensures that there is no manual intervention when receiving instructions from the scheme administrator. And all being well, those instructions come in and go straight into positioning an aggregated trade for each fund manager. I say all being well because we've got built-in validation that works with straight-through processing. So if we were to receive an instruction to disinvest more units than were in the policy, or to sell negative units, for instance, the validation that's built into the systems would stop that trade from occurring. And within 10 minutes, the scheme administrator would be notified of a potential error, and we could obviously resolve that matter. But as Jess has said, we have 99.5% of our transactions coming through straight-through processing, and a strong relationship with a number of scheme administrators. Once that instruction comes through, we aggregate the position, we create a net trade in each fund, and then automated trading is used with the underlying fund managers to buy and sell units. So again, no manual intervention in that process. And once prices are received from fund managers and calculated, we use straight-through processing at the end of the day to return contract notes to the scheme administrators, confirming purchases and sales of units. We confirm fund prices, ready for administrators to load onto their administration systems and member portals, and also unit holdings to the administrators as well. So whilst we've talked about the investment options that are available to trustees, the sorts of solutions they can access via a platform, what cannot be understated is the importance of the automation and the processes at the heart of an investment-only platform. And that really underpins the benefits and services that are available to trustees and their members. I think you've probably heard enough from me now, so I'll hand over to Jess. And Jess, over to you.
Jess, unmute yourself.
Every time. I do this every time. So hopefully we've given you some of the benefits, ideas, some of the benefits that a platform can offer you about making access available, building your investments, and making them work for you in a cost-effective way. And I think if we bring up the summary slide here, it's just to reiterate some of those points we've made earlier. And I think I saw one of the questions that came through. It's saying, how do you choose one platform over the other? And I would say that a good investment-only platform should be a partner for your scheme. It should work with you and your advisors and your administrator to support your members and to make the change that you need when you need it to happen. It should understand what you need today, but also to work with you about what you're going to need in the future. It should offer you independence. This is about your choices. This is about your requirements. It's not about the platforms. I think there was another question that asked about underlying investments and how many you can have in a blended fund. You can have as many as you like. We tend to find that 10 usually is the maximum from a reporting perspective, but some of those have multiple hierarchies, so you can have blends of blends, for example. So it really does depend on what you need. Of course, price will come into it, but when you're looking at one platform versus another, it should be about what platforms can offer you and about how they can support you. So I think if we bring up the summary slide, and I'll just run through again those options that we've kind of talked about today. So it's around that breadth of fund solutions. It's a range of fund managers accessing a variety of products that you need. It's allowing you a range of options to help you build your ESG overlays and report on them. I know there's a question that we'll come back to afterwards from the poll today. It's about accessing illiquid or non-daily dealt funds in a blend if you wish with daily ones, and still producing a daily price if you need it. It's helping you consider what your options might be now when you're looking at what you want to signpost for your at and post retirement. It's working with you to make the things that you need happen when you need it to happen. It's ensuring that you can use the bulk of the platform to minimize trading costs wherever possible, offering you that cost efficiencies through scale and helping trustees to reduce costs wherever possible for members. As we've talked about, it should give you that comfort in around a robust controls environment with end-to-end automation. For example, our people are there to add value. They're delivering the service to you. They're not there to input data. That shouldn't be what you should be seeing. You should feel that there is a definite use of the systems and that people are there just to enhance the systems and to give oversight. It's providing you with the reporting that you need in a branding that you want in a timely manner that accurately reflects the performance and the costs for transparency to your members. And finally, it should help you manage the change that you want to make to your strategy, supporting you deliver to your members for the next stage in your scheme's journey. And I think we're going to be talking about that in further depth. I think we've spoken before. We have another webinar on the 24th of September. And in that one, we're going to give you some examples of some of the transitions that we have run. We have a client as well. So it's not just us talking about what we do. It's having a client with us as well, talking about what their requirements were and how we can make change happen and how an investment-only platform can help you with the change that you need. Now, these are the items here on this summary that we feel really give you the benefit of using an investment-only platform. But I'd love to hear from all of you. So I think we do have a polling question here now, Rachel, to finish off, don't we?
We do indeed. So now that we've seen all the benefits of the investment-only platform, what do you each consider to be the main benefit of the platform? Access to multiple funds from multiple fund manager groups, cost-efficient trading and robust administration, the ability to seamlessly make changes to fund options, consistent reporting and support with governance, or you're unsure. And as you can all see, Jess and Nick, it looks like access to multiple funds from multiple fund managers was the #1 choice, followed by cost-efficient trading and robust administration.
Yeah,
so
and I think that works. Yeah, from what we see, I think that is a clear. I'm glad it's not all one or the other, but that I think that having that mix is really important, and I appreciate that. So thank you everybody for that response. Okay, so should we head into some questions then? Because I see, thank you, Pete. We've seen there's a number that are coming through.
Yes, absolutely. So we have some questions. I have some as well. I'm going to start with one that is has been added. How many individual underlying funds can you have within a client's blended fund?
Yeah, so you can have as many as you like, essentially. And as I said, you can have them within hierarchies if you want a blend of a blend. It just depends on your reporting. We've had clients before that have had 6 levels of hierarchies, and I think we've tested up to about 8 or 9. But generally it is less than 10, simply because it just makes the fact sheet somewhat more complicated if you have over 10. But you can have whatever you, as an investment-only platform should offer you whatever you like, really, around that.
Yes, if I can just add to that, I've got one particular client, and they've got a very diverse default fund that they use for their DC members. There are 13 different underlying funds within that particular strategy, and they have actually opted for sort of best in class. But the fund is so diversified, it covers everything from emerging market equity to index-linked gilts, but it's essentially a different manager for each asset class.
Right. I have another question. This is one from me, actually. You know, more and more schemes, of course, are looking at master trust.
Mm-hmm.
Is there a place for investment only, and what is the place for investment only in this market?
Sure. Well, the short answer is yes, there is a place, but perhaps the longer answer would be better, which is what we see is that we do work master trust. We have a master trust client that utilises the platform, and it gives them access to the funds that they need. So an investment only platform can support that. Increasingly, also, I would say that for we do see that the master trust is growing in this market. We do understand that. But one of the other things I would say is that investment only, and we've seen it today even from the polls around the amount of funds that schemes are utilising, that's what an investment only platform can provide you, where you have schemes that are looking to make choices on behalf of their membership, and they know their membership well, and they want to ensure that they support their membership with specific investments and pick the right fund managers for them. That is where investment only, I think, will always have a place.
Right. Very good. And just, I think I have to ask this question of every speaker. How is the pandemic impacting your business and its delivery overall?
Well, I'm missing seeing clients face to face. So that, as you can see, I'm in my front room. And so that has been a challenge, I think, because a lot of our business is about, as we're saying, about that partnership. It's sitting down with clients and be able to sit in front of them. But in terms of our actual delivery, it's been minimal. We all in our business, as I said before, it's about the end-to-end automation. We all have the ability to work from home, and the decision was taken, and within 2 hours, everyone who supports the investment only platform was at home with all of the systems up and running and working. So I think that's a real benefit, whereby you can see where where you have that end-to-end automation, it's about what the people can do to provide the oversight.
Right. Okay. And a question from the audience. How can platform providers help trustees obtain bespoke ESG and stewardship data from underlying managers to comply with the new disclosure requirements? And do you charge extra for this?
Well, I can't speak for all platforms, so I'll raise that straight away. One of the things I would say is that we are in Phoenix, that we're very aware of this. We have had a number of conversations with our clients around this, and so we're working very closely with our fund managers now around the kind of reporting they need to see. We know from ESG considerations that these are the things client wants to understand about their impact of their investments, and being able to give real proper risk ratings to their members to show about how an ESG rating works. So I would say that's something that we are looking very closely at. In terms of charging extra for it, I think, as I said, I can't speak for other platforms. I think we're just looking to understand if we can incorporate it in our reporting. We understand that we know that clients need to do it, and we will continue to work with our clients and the fund managers to make that a reality.
Right. And just more along the ESG line of thinking, what types of ESG strategies are your clients asking you for?
Nick, do you want to cover that?
Yeah, absolutely. I mean, I think each will look at requirements of the members. It needs to obviously reflect statements of investment principles as well. I think we've moved on quite considerably. So initially, it was all about screening out the bad stuff. And so you began to look at the investable universe of stocks, and probably 20-25 stocks are being screened out. We're looking at things like tobacco, weapons, construction, etc., etc. But I think the ESG screening has probably moved more onto those companies that can truly engage, and actually holding stocks perhaps in oil is more about being able to affect change and affect that at the board level of some of these organisations as well. So we've moved on, I think, from screening out to something that's a bit more inclusive and can influence change. But I think also we're seeing certain strategies that are about not economic growth, but economic development. What can these funds and strategies invest in that actually helps economies, communities, deliver and develop better outcomes, not just for investors like us, but for the population, and whether that is improved healthcare, improved schools, improved infrastructure. We're seeing a number of clients going down an ESG route that is focusing perhaps a little bit more on the social element of that. But right away across the board, Rachel, from emerging market equity through to debt-related funds as well, I think there's a greater prevalence, and we're seeing these come through not just from one or two funds managers, but a large number of the managers we work with on the platform.
Very good. And those are a few trustee-focused questions. We do have a lot of asset managers listening today. So here's a question from, I believe, an asset manager. Can you elaborate further on how a manager joins the platform? And are there some areas that are underserved, for example, private markets and the need to manage capital calls?
Yeah, happy to pick that up. In terms of the manager joining the platform, again, we can't speak on behalf of all platforms, but to join the Phoenix platform, it's about client and consultant demand. And where there is an expected demand from clients, we would work in conjunction with the consultant to engage with that funds manager and look at the requirements. And those requirements are both around operational requirements, but also ensuring that the solution is suitable for the types of investors we have on the platform, which are DC, DB, Master Trust clients. And yes, I think there are absolutely some gaps in some of those markets that have been made. But I think operationally, we're able to a lot more. I think I noticed one of the questions was around making calls for the particular funds. And again, there are processes in place, but it's working through the legalities of that with each underlying funds manager. But it's fair to say most different circumstances that are presented, they're not insurmountable. So there's always discussions with fund managers, but where there's client and consultant demand, that's the overriding feature. And we obviously find ways to provide links to the solutions that our trustees require.
Very good. And then along those lines, for blended funds, for the Phoenix platform, which liquid strategy and vehicles are permissible, especially around private markets assets?
Do you want me to pick that one up, Jess?
Sure. Yeah, go for it.
Yeah, again, I think much depends in terms of the proportion of the fund that's going to be invested in. We typically look at funds that are UCITS compliant. We accept that a lot of the private equity infrastructure funds may not be UCITS compliant, but again, there are relaxations around some of these rules. There are opportunities to put these in as a proportion of a blended fund. We wouldn't necessarily be suggesting that 100% of all monies could go into these strategies, but again, we would look at the actual fund in question, some of the restrictions around it, and it will sort of vary from fund to fund.
Really interesting. A couple of questions from a scheme, I believe. On the Phoenix platform, do you have a minimum recommended fund size, and how are your fees calculated?
So I think it goes to, that's a great question. For us, so in Phoenix, we build, as I said before, this is about the relationship with individual clients. So we tend to, so with our clients, we tend to see clients 10 million plus, but we have had some clients that aren't that size. Sometimes we get books of business whereby we have a book of business where, so it might be a number of underlying schemes, for example, that we get through a consultant, and so therefore we will work on a consultant rate across that book of business. Or there is that piece around just, so in terms of fees, it really does depend, and it depends what a scheme needs, the kind of support it wants, about the kind of reporting it needs to see. So we don't have a set fee. It's not like we say, oh, we charge everyone X or anything like that. In terms of fees, we will build it around each individual scheme, around their requirements, and work with them around understanding what change they want to make and how we can support them. So there isn't a given fee, but yeah, we will just look to understand what they need and how we can support them with that.
Right, very good. And a question came in for Nick specifically. Nick, what kind of benefits do you see for DB clients, and what size of clients do these benefits work for, in particular with the Phoenix platform?
Yeah, absolutely. I think we've got 5,500 DB schemes across the UK. A lot of them are going to be in very different positions around their funding journey. Quite clearly, I think the cash flow position as well with some of those schemes will be very different. I think historically where platforms have played is just during essentially the growth assets that they've provided. And that's very much been a historic case as DB schemes continue to see healthy inflows. But as members, as these funds have closed to future accrual, clearly those cash flows have reversed. And I think platforms have got a lot smarter by offering LDI, CDI solutions. We recognise that some of the biggest DB schemes will have direct relationships with the underlying managers. But unless you are one of those DB schemes of whether it's a FTSE 100 organisation, if you are looking at diversified investment choices, and whatever stage you are in your funding journey, then a platform may well offer you the benefits. If you're looking to utilise different fund managers, different strategies, then absolutely. I alluded to earlier books of business, and I think it's typically been perhaps a little bit more economical, where consultants with books of smaller and medium-sized DB schemes have looked to use platforms, and they have negotiated rates across the entire book of business. That's probably a more efficient way of looking at things, but the charging structure on platforms has come down considerably, and I think my answer to Linda, it's a great question, is that there is no minimum size, but it would be a case of speaking to your consultant and saying, actually, is this viable, and is this what other clients are doing?
Right. I'm going to ask the last question, but before I do that, if people want to send in more questions, because Jess and Nick have kindly agreed to answer questions by email after this. So if you lob in some more questions, we will get to them in the next couple of days. We'll send an email around. So please do feel free. So just as a last question, in terms of automation, how does the interaction between external parties actually work? You mentioned automation a bit before.
Yeah, Nick, do you want to cover that?
Yeah, absolutely. Absolutely. I think at the heart of it is straight-through processing, and straight-through processing really sort of came into our industry roughly 10 years ago, based on Swift via Nova industry standard. I think it's 20022 messaging that is commonplace throughout the industry. And in terms of that automation, it just means that the links between the third-party administrator are absolutely seamless. So we spent a number of years working with the scheme administrators, embedding this automation, ensuring that Swift messaging can be used. And it's just an industry standard method of providing, whether it's a switch instruction, a purchase of units, a sale of units, and once configured with the different fund options, the automation and the validation takes care of those instructions. I think at the other end of the process, historically, even the old faxes have been used with underlying funds managers. That's now gone. There are some very small proportion that still work on automated fax, but it's the same Swift messaging that's in place between the likes of ourselves as a platform and the underlying fund managers. And with STP, it just provides a constant, consistent, robust framework for the provision of messaging and trading. So I could probably talk about it in a bit more detail, Rachel. I'm conscious of time, or whether that gives enough of a sort of overview of how the automation works.
Well, I think we can also, you're meant to talk about a little bit more in part 2.
Yeah, we will, but I think the other thing I probably could have mentioned there as well is that the timings are so specific as well. So we know full well that the cut-off for instructions from scheme administrators, that has to happen by 6 a.m. So everything from the day before has a cut-off point. Contract notes, we know they get released at 5 minutes past 10 every single evening. We know when fund prices come in from funds managers. It's just a very streamlined process. It's been challenged by COVID, particularly with fund managers trying to price funds given the volatility of markets. But again, the process has stood up, as Jess has said, throughout the last 6 months, where we've seen volatility, we've seen big changes within markets day to day. Yet I'm sincerely hoping that the end member, whether they choose to log on to their pension at 11 o'clock at night or not, is another matter, but they will have not seen any difference in service, and the availability of prices, units, CMO transactions has all continued as business as usual.
Really good. Well, that's all we have time for today. As mentioned, Jess and Nick have agreed to answer additional questions. So if you have any, please just pop them in and we'll get to them. Today was part 1, and we have part 2 just 2 weeks today on the 24th of September. Jess and Nick will be back along with one of their scheme clients to discuss moving assets onto the platform from another provider. restructuring strategies while on the platform, and helping clients move off the platform. We hope you'll join us and invite any colleagues you think may be interested. The link is in the chat for you. Jess, did you want to say something?
No, I just wanted to thank everyone for coming today, and I appreciate we didn't perhaps get through all of the questions. So we're more than happy, and we will respond to some of those questions that we haven't got to today, and we'll come back to you. But yeah, thank you everyone for your time, and hopefully we'll see you all on the 24th.
Many, many thanks to everyone who joined us today, and thank you to Jess, Nick, and their Phoenix colleagues who helped put today's webinar together. We hope to see all of you in person before too long. Mm-hmm. And certainly in 2 weeks from today for part 2.
Thank you, everyone.
Thank you. Goodbye.
Bye-bye.
Bye.